It's kind of wild, right? Like, when you think about it, pretty much everything to do with money these days. The Federal Reserve is right there, pulling strings.
Yeah, definitely. Interest rates, inflation, I mean, those hit everyone right where it hurts their wallet.
Totally. Even if you just glance at, like, the stock market or whatever, any little wobble, people are like, oh, what did the Fed do this time? So it makes you wonder, like, how did we even end up with this whole system in the first place?
That's exactly what we're going to dig into today, right here, right
You
now.
got it, our deep dive.
We're not going to get bogged down in the day-to-day stuff.
Yeah.
We're going way back to the very beginning, the creation of the Federal Reserve itself. We're talking origins, consequences, the whole shebang. You know, what's really fascinating is we've been looking at some really interesting historical research.
See, this is what I love, because let's be real, the story of the Fed, it's like this massive puzzle, so many pieces, you can get lost in the weeds. But our goal today, right, is to help you see the forest for the trees.
That's it.
We want to pull out the most important parts, the juicy bits, the things that make you go, oh, that's how it works. So yeah, not going to overwhelm you, but by the end of this, you'll actually get it.
We're drawing from a bunch of different sources for this, historical articles, analyses, all that good stuff. One book that's worth mentioning is The Creature from Jekyll Island.
Ooh, that one.
Yeah. Whether you agree with everything in it or not, it really gets into the nitty-gritty of how the Fed came to be. Of course, we're using a whole variety of sources to give you the full picture.
Our mission, if you choose to accept it, is to understand first the history, why 1913, why create the Fed then, and the even bigger question, what's happened since? What are the lasting effects on, the U.S. economy, on us?
Okay, so before we hit the Fed, the U.S. financial system, kind of a roller coaster, right? Panics, crashes 1873, 1884, 1893, then bam, 1907, a big one.
Not exactly a smooth ride.
No, not at all. And here's the thing. These weren't always happening during, like, widespread economic doom and gloom. From what historians tell us, it seems like a lot of these crises were tied to this thing called reserve pyramiding and something they call excessive deposit creation.
Okay, wait. Reserve pyramiding? I'm already lost.
Think of it like a stack of containers, right? Smaller banks out in the country, they put their reserves, their cash basically, into bigger banks in cities. Then those banks, they'd send a chunk of that money to the biggest banks in New York City.
So like a pyramid scheme, but with money.
Kind of, yeah. But the
Okay.
problem is, at the very top of this pyramid, there wasn't that much actual physical cash compared to all the deposits floating around. Exactly. So if suddenly everyone wanted their money currency drain, they call it, even if the economy itself wasn't in bad shape, the banks were screwed. They'd lent out so much they didn't have enough cash on hand to actually pay everyone back.
Like playing musical chairs, but someone took away like half the chairs?
Yeah, pretty much. It wasn't that the whole system was weak. It was the individual banks inside it. They were running on fumes, cash-wise.
So not a sick economy, but kind of like a financial system with a bad case of the sniffles, susceptible to, sudden sneezes.
Perfect analogy.
Thanks. So what was the big idea, the solution to fix these constant financial sniffles?
The idea that caught on, especially with the big bankers, was that we needed more flexible money. Elastic money, some called it.
Stretchy money.
Yeah, kind of. The thinking was you need a central authority, someone who can control how much money is actually out there circulating, respond to what the economy needs.
I'm seeing the rubber band metaphor here.
Exactly. Expand, contract, keep things stable, keep interest rates low, encourage people to borrow and spend.
Okay, so this is where things get juicy. Enter Jekyll Island, the super secret meeting. Tell me everything.
All right, so November 1910, right? This group of financial bigwigs, they sneak off to the Jekyll Island Club. It's this exclusive private island off the coast of Georgia.
Sounds fancy.
Oh, it was. They even traveled in style Senator Nelson Aldrich's private railway car. Imagine plush armchairs, a full bar, servants catering to your every whim.
Not your average Amtrak experience.
Not even close.
Yeah.
And on the outside of this luxurious car, a single plaque that simply read, Eldridge. No subtlety there.
Eldritch. Well, that's one way to make an entrance. And Senator Aldrich wasn't just some random rich guy, was he?
Oh, no, not at all. By 1910, Aldrich was the power player in the Senate. He was basically big business's best friend in Washington. He had all these financial ties to J.P. Morgan through investments and partnerships.
So deep in the pockets of Wall Street.
Deep.
Yeah.
And get this, his son-in-law was John D. Rockefeller Jr. and his grandson, Nelson Aldrich Rockefeller, future vice president of the United States. We're talking about a dynasty here, deeply embedded in the American power structure.
Okay, so Aldrich, the well-connected senator, provides the swanky ride. Who else was on this secret mission to Jekyll Island?
One of the key players was Paul Moritz Warburg. Now, Warburg is a fascinating character. He was a big deal in European banking, part of Warburg and Company, operating out of Hamburg and Amsterdam. He'd only been in the U.S. for like 9 years at this point.
A newcomer.
Yeah, but don't let that fool you. He and his brother, Felix, they were already partners in Kuhn Loeb and Company, one of the most powerful investment banks in New York. They had serious financial backing, mostly from the Rothschilds. Fast forward a couple of decades, and Paul Warburg is one of the wealthiest and most influential men in America, especially when it comes to railroads.
So we've got a powerful senator with Wall Street ties and a European banker with connections to, like, global finance royalty. Anyone else in this exclusive club heading to Jekyll Island?
Well, that's the thing. The other attendees, their names were never officially revealed. They all agreed to keep it super hush-hush, a vow of silence, the whole 9 yards.
Like a secret society.
Exactly. And get this, there's this funny story about Paul Warburg trying to keep his involvement a secret. His son, James, said that his dad, who wasn't exactly an outdoorsman, borrowed a shotgun and took it on the train with him.
A shotgun?
Yeah, he was trying to look like a duck hunter in case anyone recognized him. Talk about a cover story.
Wall Street banker playing duck hunter.
Cool.
Okay, I gotta know. What happened on Jekyll Island? What did this financial dream team cook up?
They came up with a plan for a central bank in the U.S. But there was a catch. The term central bank, not exactly popular back then.
People were still kind of spooked from Andrew Jackson's fight with the Second Bank of the United States, right?
Exactly. So they knew they couldn't just come out and say, we want a central bank.
Too much baggage. So they needed a sneaky plan to get this thing through Congress and past the American public. What was their strategy?
It was pretty clever, actually. First rule, no using words like cartel or central bank. Those were off limits.
The central bank is canceled.
Exactly. Instead, they decided to dress it up as a government agency. You know, something to promote financial stability, that kind of thing.
Make it sound all nice and official.
Right. And to calm people's fears about Wall Street running the show, they came up with this idea of regional branches. Like, it wouldn't just be some big, scary institution in New York City calling all the shots.
Decentralization for the win.
And their most cunning move. They decided to start with what seemed like super conservative banking principles. That way, it wouldn't seem too radical. But they knew once the system was up and running, they could tweak the rules later on.
Ah, the old bait and switch.
You got it. Sneak it in under the radar, then mold it into what they really wanted.
It's like a financial Trojan horse. So who was the public face of this plan? Who was out there selling it to the people?
Paul Warburg. He became like the central bank evangelist. He gave speeches, wrote articles, even published this whole 11-part series in the New York Times, laying out his vision for a Reserve Bank of the United States. He was the brains and the voice of this whole movement.
The intellectual architect of the Fed. So Jekyll Island was the secret origin story, Warburg's the front man, but there were still some major hurdles to jump through back in Washington. What was the mood like in the country at the time? How did the 1907 panic play into all of this?
Well, the 1907 panic was a real turning point. It actually kind of surprisingly humbled Wall Street.
Really?
Yeah, they couldn't handle the crisis on their own. And that kind of opened the door for the idea of like a national solution. Instead of Wall Street being seen as the big bad wolf that needed to be chained up, some people started thinking, hey, maybe we need a stronger authority to stop these panics from happening.
So the crisis kind of backfired on Wall Street, paving the way for more government intervention?
Exactly. It was a shift in the narrative. And even some on Wall Street started thinking, hey, maybe a bit of government backing wouldn't be so bad.
A little stability goes a long way. So in the aftermath of that 1907 mess, we get the Aldrich-Vreeland Act of 1908. What was that all about?
Think of it as a Band-Aid solution, something to get us through the next crisis. It had two main parts. First, it let national banks issue emergency currency, this stuff they called script.
Script, like handwritten IOUs.
Not quite. But the idea was, if a bank was running low on cash, they could use this script to meet their obligations. They could back it with things like government bonds or even commercial loans.
So basically, turning their assets into something that looked like cash without actually having to sell them off in a fire sale?
Exactly. Keeps the system moving. And the second big thing, the Aldrich-Vreeland Act basically made this whole script thing legal. See, during the 1907 panic, some banks had been doing this informally, but it wasn't really official.
So they were like, let's make this a real thing in case we need it again.
Right, a temporary fix to avoid those panics. But the central banking folks, They wanted something permanent. They had their sights set higher. And that brings us to the Aldrich Bill. But didn't go so smoothly, did it?
Not exactly a slam dunk. Why did the Aldrich bill hit a wall in Congress?
It all came down to Senator Aldrich himself. He was powerful, sure, but he was also seen as Mr. Wall Street. And a lot of people just didn't trust him with that much power over the nation's money. They were like, you want to give the guy who's buddies with J.P. Morgan control of the money supply? No way.
Yeah, that's a tough sell.
Yeah.
It wasn't the idea of a more stable system that people hated. It was the messenger.
Exactly. And there was even some drama about what to call the bill.
Name game drama.
Oh, yeah. Warburg, smart cookie that he wanted to call it the National Reserve Bill, or maybe the Federal Reserve Bill.
Sounds official, trustworthy.
Right. But Aldrich, he wanted his name on it, the Aldrich Bill. Warburg tried to tell him, dude, that's going to scare people off. But Aldrich was stubborn.
Ego getting in the way, as usual.
Pretty much. So while the Aldrich Bill was struggling to get off the ground, there was this whole other thing brewing the money trust. People were starting to get really worried about the concentration of financial power in the hands of a few.
Like the 1% of the 1%.
Yeah. They were talking about a vast and harmonious banking power that could basically control the whole economy. And that fear is what led to the Pujo Committee in 1912.
Pujo Committee, like a congressional investigation.
Yep, a subcommittee of the House Banking Committee. Their job was to investigate this money trust, see if it was real, and if so, how dangerous it was.
So who'd they pick to lead this investigation?
Arsène Pujo, a congressman from Louisiana. Now, here's the interesting part. Pujo himself was seen as a mouthpiece for the oil trust.
Wait, one trust investigating another trust? That's kind of ironic.
Right. It made some people wonder if this whole investigation was really about cracking down on concentrated power or if it was just a political game.
So what did the Pujo Committee actually find out?
They had these long, drawn-out hearings, tons of documents, interviews with all these Wall Street guys. But a lot of people thought it was all for show. They said there wasn't any real hard-hitting questioning and that the bankers were basically just allowed to say whatever they wanted.
So a lot of smoke and mirrors, but not much substance.
Pretty much. But while all that was going on, the folks pushing for a central bank, they were busy working behind the scenes trying to win over influential people.
Got to get those endorsements.
Right. And they managed to get a big one. A very prominent educator who later became the governor of New Jersey, and then, you guessed it, President of the United States.
Sounds like Woodrow Wilson.
You got it. And what's interesting is that during the 1907 panic, Wilson himself had said something about wanting a small group of public-spirited men like J.P. Morgan to basically run the country's finances.
So maybe Wilson wasn't as anti-Wall Street as he made himself out to be.
Maybe not. And this brings us to the Glass-Owen bill, the one that actually created the Federal Reserve. So how did we go from the Aldrich bill, which was dead in the water, to this new bill under Wilson?
Yeah, that's a pretty big leap.
Well, the political landscape changed completely when Wilson became president. And get this, Wilson himself admitted that he knew basically nothing about banking. Kind of a shocking admission, right?
A little concerning for the guy in charge of the country's money.
Yeah, but here's the thing. This whole movement for banking reform, it was really being driven by this small group of guys who had all known each other for years, and they were all on the same page about what they wanted.
A small, tight-knit group, pulling the strings. So what were the big problems with the Aldrich bill, the things that supposedly justified the Glass-Owen bill?
Well, in 1913, Carter Glass, he was a congressman who played a big role in shaping the new bill. He came out and said, look, the Aldrich bill is bad news. He said it didn't give the government enough control. It gave too much power to the big New York banks. It was basically a recipe for inflation, and it was going to cost taxpayers a fortune. Oh, and he also called it a banking cartel.
So not exactly a glowing review.
Not at all. And those were the arguments they used to sell the Glass-Owen bill. They said, look, this is the solution to all the problems of the Aldrich bill.
Sounds good on paper. But were the hearings for the Glass-Owen bill any more transparent? Did they actually listen to people who disagreed with the plan?
Some people said the hearings were basically a joke. They said the bill was already written and that the hearings were just for show. They even said that people who opposed the Jekyll Island plan, like Congressman Charles Lindbergh Sr., weren't allowed to speak.
So it was all rigged.
That's what some people said. But they still needed to make the bill look appealing to enough people to get it passed, right?
Got to keep up appearances.
Exactly. So they put in some things that sounded good, stuff they knew they could change later. And they made some compromises to win over the populists, the folks who followed William Jennings Bryan. But Wilson himself later said that these compromises were just shadows, meaning they didn't really change anything important.
Smoke and mirrors again.
Yep. Now here's where things get really interesting. What was the money trust doing during all this?
The supposed villains of the story.
Right. Well, some people say that they were actually playing a very clever game. They wanted Wilson to be president, so they supposedly helped make sure Taft lost the election by encouraging Teddy Roosevelt to run as a third-party candidate.
Split the vote, hand Wilson the victory.
Exactly. And even though Wilson campaigned against the money trust, there are claims that they secretly gave money to both Wilson and Roosevelt.
Talk about playing both sides.
Right. And then you have Colonel House, this mysterious figure who was close to J.P. Morgan and Paul Warburg. Some say he was basically the unseen president, whispering in Wilson's ear, guiding the Glass-Owen bill through Congress.
The puppet master.
And get this, there are even claims that some of the big Wall Street guys, like Aldrich and Vanderlip, they pretended to oppose the Glass-Owen bill.
Why would they do that?
To make it look like the bankers weren't actually in favor of it. You know, trick Congress and the public.
Wow, that's some next-level manipulation. So after all that drama, all the secret meetings, all the political maneuvering, the Jekyll Island crew got what they wanted.
They did. On December 23rd, 1913, the Federal Reserve Act became law. And just like that, after decades of fighting against it, America had a central bank again.
And what happened next? What was the harvest of the Federal Reserve?
Well, as they say, the proof is in the pudding. And one of the first big things to happen after the Fed was created was the stock market crash of 1929.
The big one.
And some people say the Federal Reserve played a big role in making that crash happen.
How so?
Okay, so the story goes that the big New York banks, they wanted to crush the smaller banks, the ones out in the country. And they used the Federal Reserve to do it. First, they made it really easy for farmers to borrow money, encouraged them to take on tons of debt.
Sounds familiar.
Right. Then they tightened credit, made it harder to borrow, and boom, recession. Farm incomes plummeted, farmers couldn't pay their debts, banks started failing, and guess who scooped up all the pieces?
The big New York banks.
Bingo.
So they basically engineered a financial crisis to benefit themselves. Ruthless. And what about those bankers' acceptances? What role did they play in this?
Bankers' acceptances, they were like these short-term IOUs, guarantees of payment. Usually they were considered pretty safe, but when the economy goes sour, even solid businesses can go belly up. And guess what? Too many of these things floating around had almost bankrupted big-time financiers like George Peabody and even J.P. Morgan in the past.
So they knew these things could be risky. And what about Montague Norman, the head of the Bank of England? Why was he sneaking into the U.S. right before the crash?
Yeah, February 1929, Montague Norman shows up in the U.S. unannounced. He had secret meetings with the Federal Reserve and with Andrew Mellon, the Secretary of the Treasury.
Sounds shady.
Right. Nobody knows exactly what they talked about, but some people think that the central bankers on both sides of the Atlantic, they knew the bubble was about to burst. They knew the stock market was way overinflated.
And they didn't try to stop it.
Well, that's the theory. Some say they decided to just let it happen, let the air out of the tires, so to speak. They figured it was better to let the bubble burst on its own than to try and deflate it slowly and maybe get blamed for causing a recession.
So they just stood back and watched the whole thing blow up.
That's what some people believe. But they weren't just passive observers. In August 1929, the Fed did a couple of things that some say were the triggers for the crash.
What did they do?
They raised interest rates, which made it more expensive to borrow money. And they started selling off government bonds, which sucked money out of the economy.
So they made it harder to get money and made money more expensive? Not exactly a recipe for a healthy economy.
Nope. And the effect was immediate. Interest rates on brokers' loans, the money people used to buy stocks, went through the roof. We're talking like 20% interest.
Ouch.
Yeah. And then, on October 29th, it all came crashing down. Black Tuesday. But there were some people who saw it coming, didn't they?
Oh, yeah, the insiders. They always seem to know what's going to happen.
Right. There's stories about people who got tipped off, people who knew the crash was coming. They sold all their stocks before the bottom fell out, turned everything into cash and gold. Then, when prices were at rock bottom, they swooped in and bought everything up for pennies on the dollar.
Making a killing on everyone else's misery.
That's how the game works. And what's even crazier is a lot of those companies that went bankrupt, they weren't actually bad companies. They were just victims of the crash.
So the crash created an opportunity for the big guys to gobble up the little guys?
That's the idea. And that's why some people say that giving anyone the power to control the money supply is a really bad idea. In fact, The source material says it pretty bluntly. When men are entrusted with the power to control the money supply, they will eventually use that power to confiscate the wealth of their neighbors.
Strong words.
Yeah, and they use the 1929 crash as the perfect example.
So after the crash, when the economy was in shambles, what did the government and the Fed do? Did they help people out?
Well, that depends on who you ask. Some people say they used the crisis as an excuse to grab even more power. Hoover started a bunch of programs trying to control wages, prop up failing businesses, that kind of thing.
Interventionist policies.
Right. And then FDR came along with the New Deal, which was even bigger. And the Fed, they pushed through a bunch of so-called banking reforms, which actually just gave them more control.
So the crash actually made things worse in terms of centralized control.
That's the argument some people make. Now, let's talk about another big piece of the puzzle. Fiat money. What is that exactly?
Fiat money, it sounds fancy.
It's basically money that doesn't have any real value in itself. It's not backed by gold or silver or anything like that.
Like the US dollar.
Exactly. The dollar is fiat money. It's only worth something because we all agree that it's worth something, and because the government says it's legal tender, meaning you have to accept it if someone tries to pay you with it.
So it's all based on trust and faith.
That's it. And the argument is that this kind of money is created out of nothing. Or, more accurately, it's created out of debt. Think about it. If everyone paid back all their debts at the same time, all the money in the system would disappear.
That's a mind-blowing thought. So if money is created out of debt, what does that mean for interest?
Well, some people say that charging interest on this kind of money, money that's created out of thin air, is basically a form of legalized theft. They call it the Mandrake mechanism.
That's magical.
Right. But it's not magic. It's just the way the Federal Reserve works. They can create new money by lending it into existence. And the problem is, this new money doesn't represent any real wealth or productivity. It's just like inflating the money supply.
And that leads to inflation, right?
Exactly. When you create more money, it makes each individual dollar worth less. It's like diluting a drink. And this cycle of creating new money, inflating the bubble, then having the bubble burst, that's the boom-bust cycle. And it's a problem that's plagued every society that's tried to use fiat money.
So we have fiat money created out of debt, leading to inflation and boom-bust cycles. And then there's the Fed's role as the lender of last resort. That sounds kind of noble, like they're there to save the day when banks get in trouble.
It does, doesn't it?
Yeah.
And that was one of the main selling points for the Fed. They said, look, we'll be a safety net for the banking system. If a bank's about to go under, we'll step in and lend them money.
So they're the bank for the banks.
Exactly. And that sounds good, right? Except there's a catch. When the Fed creates new money to bail out a bank, if that bank doesn't pay the money back, guess who ends up footing the bill?
The taxpayers, as usual.
You got it. The cost gets passed on to everyone else in the form of inflation. So it's like we're all on the hook for the bank's bad decisions.
Socializing the risk, privatizing the profits. And the source material has some pretty damning examples of these bailouts, doesn't it?
Oh, yeah, tons of them. Penn Central in 1970, New York City in 1975, Chrysler in 1978, Commonwealth Bank of Detroit in 1972, First Pennsylvania in 1980, Continental Illinois in 1982. The list goes on. And the argument is that these bailouts always seem to benefit the banks and their shareholders while the public gets stuck with the bill.
And wasn't there a big stink about Continental Illinois? Because it was so big that if it had failed, it would have wiped out the entire FDIC fund.
That's right. They said it was too big to fail. And that's the problem with having this lender of last resort. It creates a moral hazard. Banks know they can take big risks because the Fed will always be there to bail them out.
And because they know they'll get bailed out, they can get away with holding less cash in reserve, right?
Exactly. They only need to keep a tiny fraction of their deposits on hand. It's like a casino where the house always wins.
So the whole system is rigged in their favor. And the FDIC, the folks who insure our deposits, they're part of the problem too, aren't they?
Well, the FDIC is supposed to protect depositors, but if a bunch of banks fail, they might not have enough money to cover everyone's losses. And guess who ends up paying the difference?
The taxpayers again. It's always the taxpayers. So the big takeaway here is that the Federal Reserve isn't really there to protect the public. They're there to protect the banks.
That's the argument some people make. They say the Fed is basically a cartel operating in the interests of its members, not the public.
And what about the national debt? How does the Fed play into that?
Well, the Fed doesn't hold all of the national debt, but the system they created is what allows the government to keep borrowing more and more money.
Print more money, rack up more debt.
Right. And the amount of money they've created through this system is way bigger than the actual debt the government has taken on. Some people say it's like 10 times bigger. And all that new money, it's fueling inflation.
So it's like a hidden tax that we're all paying.
That's the idea. So to sum it all up, we have a system that was created in secret, a system that benefits the banks at the expense of everyone else, a system that creates inflation and boom-bust cycles, and a system that's drowning us in debt.
Not exactly a rosy picture.
Nope. But the point of this deep dive isn't to depress you. It's to make you aware of how the system works. Because once you understand the system, you can start to think about ways to change it.
Exactly. Knowledge is power. So here's something for you to think about, listener. If we know this system is flawed, what's the alternative? What would a fair and stable monetary system look like? How can we create a system that serves the people, not just the banks?
Those are the big questions, and they're not easy to answer, but they're questions we all need to be asking.
Absolutely. The future of our economy depends on it.